So what is dollar cost averaging, and why is it known as quite possibly the best investment strategy to implement? Really, in a nutshell, dollar cost averaging is taking an amount that you have to invest, divvying it up into equal amounts at regular intervals over a longer period of time. What does it really help to do? It helps to avoid, one, timing the market, and two, it allows you to continually invest in the market. So let's talk about a more specific example. Now, this is a very simplified version, but hopefully it helps to get the point across. We have two investors, Jack and Diane, and they both have $1,000. Jack decides he's going to make a one-time investment, while Diane decides she's going to dollar cost average. So we have a couple charts to go over this, so let's take a peek. Note that Jack, again, makes a one-time investment in XYZ mutual fund, and it's pricing at $50 a share. So Jack's able to buy 20 shares. Now, the price of the fund over this set period of time tends to fluctuate quite a bit, dropping as low as $25, but it does end up recovering to his $50 per share. So Jack's basically flat on his investment. Now let's talk about Diane, who wants to dollar cost average. So as we look at the chart of Diane's investments, she divides that up into 5 separate investments of $200 apiece. Notice that she makes the same investment at the beginning as Jack, only she purchases 4 shares. And then she also invests at those different increments over time. Note, she's purchasing more shares as the price retreats. So as you can see in this very simple example, Diane is able to participate in investing in XYZ when the price goes down, and that leads to her making a profit as prices recover. So we do need to mention a few considerations around dollar cost averaging, though. Primarily, the strategy is so successful because it does make an assumption that prices are going to eventually increase over time. Obviously, dollar cost averaging is not going to prevent you from losing money if an investment, continues to decline over time. So it really does make that assumption of increased prices. It's also not a strategy that protects you on the downside if you have intentions of not having a longer term time horizon. But what it can do is help to prevent losses when markets decline and lead to greater gains when markets or your investments eventually rebound. What's a real life example of this? Think like a company 401k plan. You have every pay period, you have a specific dollar amount being withdrawn from your paycheck, and you're investing that into the allocations that you've set forth in your company's retirement plan. So hopefully that sheds a little light on dollar cost averaging, and we thank you so much for tuning in.